what is it makes a good accountant? And there was a whole heap of questions about the accountant profession and what should you be asking your accountant, and it just went on and on. So what better way to turn now this webinar on stuff that maybe your accountant may or may not tell you. So that's what we're going to be talking about today. But a couple of things, guys, and let me fill you in on a couple of things. Here's a very important warning. You're going to get some great insights, and this webinar will help your business. So try and stay focused. Have pen and paper ready. If you've already got your coffee, great. I know some people have got their coffee intravenously put into their arms. So guys, you're going to get some good insights. So let's stay focused. I'm more than happy for you to ask questions along the way and go from there. So really, really looking forward to it on what you're going to provide and all of that. So I've just had someone who said they can't hear me at the moment. Unsure if that's changed, Bennett, or not. Can I just give everyone raise their hands if they can hear me? There's a little button on the webinar bar. If they can hear me okay, if they can raise their hand. Yep, excellent. Thanks, guys. All right, so unsure what's happening with Janet. So guys, let's really get stuck into it. Let's turn this webinar into something huge. So I'm just going to give you a brief outline of today, really a bit about our presenters, bit about me and about the presenters, just so we can earn the right to talk, might be a good way. We're going to do a couple of polls throughout the thing, and then I'm going to go through and talk to you about what are the 5 things that your accountant may or may not tell you. And then we're going to hear from the accountant himself. So I should have secretly gave his name as John Smith, just in case his profession might get out there and lynch him. But no, that's not going to happen. But I've seen what he's going to talk about, and it's going to be great. And then at the end, we are going to have any questions and answers. You've got Bill on the line to ask any questions you may want, or regarding accounting, or anything regarding the business. So this is your opportunity to ask any questions you may need. So guys, let's get stuck into it. First point is a bit about me. Quite simply, I've been in business longer than what I've been training in martial arts and helping business owners out longer than that. And as you can see, I'm a tiny bit bald there. But I'm just sharing a couple of my wonderful clients who are working their way up through the Black Belt Business Growth Education Program. And really, if you have a look at that picture there, me looking like I'm choking one of my students, I was lucky enough to be asked by the largest martial arts magazine out there to do some how-to tips on martial arts. And Blitz magazine, I've got articles coming out pretty much every month till the end of the year on how-tos, on different techniques and different scenarios. But reality is business and martial arts are very, very much similar. You need the same type of focus, the same type of attitude, the same type of confidence, and also the same type of foundations when you first start, as in martial arts. And that's why I link the two very much. So both of my passion, whether I'm passionately helping business owners or whether I'm passionately helping students be a lot more confident. I don't teach people how to fight. I teach people to be a lot more confident. So that's a bit over me. Got some really, really great team behind me, and it's fantastic. So let me fill you in on Bill. Pixelated Bill here. I took his photo off the website and it's sort of like panned out, and you can see it all pixelated. But he's a CPA, he's business, Brisbane based, and his passion's his numbers. And I guess you'd need an accountant who would have is passionate about numbers. I guess that is important to really have. So I'm looking forward to hearing from Bill and what he's got to say very shortly. So guys, let's start off with a really, really quick poll. We want to find out, and I guess my question is, do you get all you need to out of your accountant? And I'd love to hear from you. Please be as honest as possible, guys. If you can let me know if you get all you can out of your accountant. So thank you for the responses, guys. Yeah, it's looking how I may have expected it. Okay, interesting. The numbers are changing a tiny bit more. So a few more minutes. Hey, Bill, you can do the poll as well. So let's see what you do. Let's see what you say. By the way, I can't see your answers. I can only just see the percentages, so I don't know what you're answering or not, but be quite interested. All right, guys. Most of you guys have voted. 90% of you have voted. Very, very interesting. And I don't know if you know what the overwhelming response is. But let me actually go and close this for you and let me share the results for you. Quite simply, when we look at this, 11% are saying yes. Out of all the people online at the moment, which, how are we looking at? Quite a few guys. We've got quite a few people online. We're looking over 30 people online at the moment. Only 11%, only three of those people get yes, they get out of their accountant. 39% is sort of, which is, I was expecting that one to be higher than most of it, but 44% aren't sure. And I guess the question you need to be asking yourself straight away is, what aren't you sure about? And then 6% are saying no. So 6% of the people on the line at the moment aren't getting their most out of their account, or don't know if they probably don't know what they need to get out of their account at the end of the day. And this is why I brought this topic up, because I get to meet so many business owners day in, day out. And one of the questions I do ask them is, do you have a good accountant? Because they are fundamental in the business, and making sure that they get what you need to in your business and be able to help you grow the business with you. And Bill's going to talk about that at the when he comes on, about the development and what you need to do for the accountant to get the most out of him. So very, very good, interesting topic. So guys, very interesting results. That 44% of not sure is quite a bit higher than what I was expecting. So awesome work. So, guys, let me fill you in on something. And today is not about one simple thing. We will not bag out accountants. I don't do that. They are necessary in the business. I'm not here to say, hey, whether you've got a good accountant or not. What I'm here is to give you some information on some of the things that you should be asking your accountant, some of the things to get the most out of them, exactly like that poll I just said then. I'm talking about being able to go back to them and go, right, this is what I actually need at the end of the day. And Bill's going to be more about that. I'm not a qualified accountant at all, though one of my first jobs out of school for very many years was installing accounting software at large organizations like Napoleon Purtis Cosmetics, Gloria Jean's Coffee. I used to manage all their accounting systems there. So I do have a sort of, I do understand accounts fairly well and KPIs and whatever else, but I'm not here again to bag accountants. I'm here to help you guys work with them a lot better. And that's the whole idea of this webinar. So guys, let's get stuck into it. So pens and papers at the ready. What are the things that you may or may not being told? And reality is, maybe I should create a poll for this one. But the first thing we need to look at is, are you really understanding your break evens in your business? Do you know what they are? Do you know what you should be looking at? And what makes up the break evens? The first thing, whenever I go and meet a new business, which is literally almost one a day, new business owners, one of the first questions I ask them is, how much does it cost to open your doors? And I'm going to pose that question to you now. You don't have to answer it. This is just more of a rhetorical question, but it's one that I want you to think about. How much does it exactly cost to open your doors? And most of the time, I'm going to say most, cannot give me an answer. They roughly know. Their gut tells them that it's roughly this amount, or I need to make this many amount of sales to get where I need to. But the problem is with break evens, that's all about the nows. What is it that we need to actually have a look at in your break evens to grow the business for the future? And it's interesting. Should your accountant tell you what your break evens are? Well, I believe they do. I believe part of their process at the end of the year is to go, right, did you know it's actually costing you $4,583 to open your doors every single day? So what we need to do is ensure that your sales targets and all of that meet those businesses. And this is such an important thing. And as soon as I work on that with business owners and work out what their break evens are, because it's a very simple thing to do, what we do is we go, wow, I need a few more sales than what I was expecting. My gut was actually wrong, or something to that effect. So one of the first things we need to look at is calculating your break evens in your business. And I've got a very simple method at Black Belt Business on how we do that. I've got a really good spreadsheet that works out your break evens and how much sales you need to make on a daily, weekly, fortnightly, monthly, and yearly basis. So after this, I'll send the Excel spreadsheet to you. Very simple to do, very powerful exercise to be doing in your business. So, guys, I'm happy to send that spreadsheet to you afterwards. Though, let's have a look at our break evens. What makes up break evens? And this is where a lot of people miss it. And everyone thinks, yes, profit and loss expenses. That does make up your break evens. It really does. You've got to have a look at all your profit and loss expenses, your rent that you're paying, your marketing that you're doing, even though marketing is not really an expense. I don't know why it's in that column. It should be an investment any which way. I'll get off my soapbox now. So, all your rent, all your electricity, all your phone calls, your profit and loss expenses are really the areas that if you did not get any more sales, how much do you still need to pay to run your business? You've got ASIC fees, you've got cleaning if you need to have your offices clean, you've got travel, you've got motor vehicles, you've got all of those profit and loss expenses. You still have to pay whether you are opening the doors or not. Now, this is the next point I want to talk to you about is one thing that not a lot of people actually factor into their break evens, because reality is, what about your loans and your leases? Everyone looks at their profit and loss and go, woo, I've just made $30,000 profit. Yay. Look at their bank account and go, but I've got minus $5,000 in my bank account. I'm in overdraft. Why am I like that? Why? I don't understand it. Look at all this profit that I made. Reality is, because when you calculate break evens, we have to include all your loans, any leases, any taxes, anything like that that come out. Break evens is all about cash, guys. You're in business for one reason and one reason only, and that is to make money. Unless you're a charity here, and I won't get you to put your hand up if you're a charity, but reality is you're in business to make money. I know it may give you a lifestyle and all of that, but it's very important that you've still got to make money at the end of the day. So when you actually do your break evens, it's not about your profit and loss statement. It's all about your break evens in terms of cash. What are my cash break evens? Now, it's really funny with clients. I go down into a lot more detail. I go break evens business, but I also go break even personal. Add those two together, and that will tell me how many sales that need to be made in the business to move forward from there. So, what is coming out of your bank accounts? What is anything that's in your balance sheet area? Anything like that, that needs to be included in your break evens. The next one is, how much money do you need to take? Remember, I just spoke about the break evens personal. How much money do you need to take out of the business? You've got to include that in there. You're not doing it for love. So many businesses I see where they pay all their team first before they pay themselves. And that's, look, it's good because you're keeping people employed, you're keeping the business running. But at what stage do you sit there and go, hang on a second, this is really wrong. I'm the one working 60, 70 hours a week. I'm the one taking all the risks. I'm the one that if this business fails, that it's attached to my mortgage, I could be losing everything. So what is it do you need to take to get your owner's drawings? What are you going to take out of the business? How much do you want to pay yourself? And this is the biggie, guys. The next one, when you calculate your break evens, have you ever thought about the future capital investment that you need in your business? Now, it's quite interesting when you look at break evens, and I ask the break evens for business owners, they go, look, I've worked it out, it's this. Great. So over the next year, what do you need to invest into your business to actually to grow it, to keep it there? Because it's so funny. All of a sudden, you've got your budgets and you've got all of that worked out and you've got all your break evens out. Next thing you know, your $5,000 computer blows up. Well, did you put that in the break evens? Did you actually go, right, I know over the next 12 months I need to buy 2 more computers, 3 more computers, 5 more computers? What future capital investment do you need to make in your business to keep moving forward? So, I know I was particularly working with one client. They did cabinet making, and effectively they knew that they needed to invest $40,000 into new machinery, and that would actually reduce their team numbers by 2 team members. Just this one machine would actually easily do that. So when we did the break evens, we had to factor that in. Then we had to build the sales up to get to that point. So we knew we could afford that capital investment, rather than all of a sudden having emergency stuff happening. It's like, oh, that machine blew up. I better then go and have to go and buy a new machine. And next thing you know, yes, my profit is $30,000, but I've only got minus $5,000 in the bank account because all your profit went in buying that new machine, which wasn't factored in. So the last thing is, guys, you're in business for one reason, and that's profit. Let's face reality. The reason I talk about having profit in your break evens is quite simply, yes, you need the money to survive at home, but your profit is there to actually grow the business more. Keeping that profit in the business can, so you can reinvest in and work it out from there. So, guys, if you really had to break it down into your break evens, and I don't know if you're, and again, we're talking about your accountants not telling you, but I want to know that, do you actually put all of these in when you calculate your break evens? Did you know that these are all the things that you need to start factoring in so you can know exactly what your sales targets are? So we've really got to have a look at all of these items when you do it. So many times I walk into an organization, I say, yeah, my account set up a budget, but it's only a profit and loss budget. It's great to hit budget, guys. I've got no problems with that, but it's all the other underlying things. Always look at your bank account. Always look at the cash in your business is very, very, very important. So the benefits of working out your break evens: one, know them. Right? It's very important that you know what your sales targets are. So many people will keep running their business into the ground, hoping that sales will pick up, and reality is they're going backwards. If you knew your break evens, you know immediately that that sales target needs to be hit every single week, and if you don't, you're now going backwards. So it's a very good monitor on what you should be looking at. Use these as a basis of your budget. So go and use this to enter into for your budgets, and we're going to talk about budgets shortly, but use it as a basis. The also thing is you set your sales targets. Very, very important that, these break evens will then show you how much sales you need to make, which then in turn will then show you what you need to break it down and how much sales you need to make. Then you can take those sales targets and go, right, my highest margin product is X, Y, and Z. That's the one I need to go and market because I know I'm going to make more money of it. And off you go and just focus on that one area. And again, that's probably a conversation for another webinar about how to set the right sales targets and all of that. So let me know if you'd want something like that, and I can help share how to set really good sales targets and hit them every time. But anyway, set your sales targets. Your break evens will help you do that. And anything that's monitored will actually change your business. It's really interesting that. And you should be reviewing them quarterly. Expenses go up. How much has electricity gone up over the last couple of years? I almost fell off my chair when I got the last electricity bill in. So review them quarterly. Very important. Then once you're reviewing them, what you got to do is then ask yourselves the question, why is that so high? Is there a better way I can reduce that? What do we need to do with that? So sit down and actually do this exercise every 3 months so you know exactly where your business at as you're growing it and as you're moving forward. So, guys, that is all about break evens and knowing that. And whether you've gone into depth with that or if that's the first time you've heard all that breakup and what needs to go in, very, very important that we can actually set that. And if you've got a bookkeeper, guys, I should have actually said, as well, your bookkeeper should be able to help you easily put this on. I know there's a couple of bookkeepers on the line at the moment, and I know definitely one of them does this type of stuff for you. So if you've got a bookkeeper, ask them to actually help you create all of this stuff and go give them the exercise or go give them the spreadsheet I'm going to share with you and get them to work that out for you. So, guys, that is break evens. Absolutely important, imperative to do in your business, and maybe or maybe not, your accountant will actually share that with you and go into that much depth. So, guys, the next thing I'm going to talk to you is about tax, and this is it is a real life situation that I did send out. I've kept the names different, so you guys don't know company names. I've kept the scenario different, but the email you may have received on Monday talked about, is it a good thing to minimize tax or not? And one of the things that I always find, and when I deal with the accounts, a lot of accountants like to minimize tax. Who, put your hand up here if you love paying tax? Let me see if you love paying tax. Put your hand up. Put your hand up. Yay, excellent. I've got one person with their hand up. And oh yes, they're one of my, oh look, two people with their hand up. Yep, because they're two of my clients. So guys, I encourage my clients to love paying tax. And I know that sounds really funny, and why should you pay tax? But reality is, you're paying tax, you're making money. And that's very, very important to understand. When you're paying tax, it means you're making money. What more than likely happens, the reason people don't like paying tax is because all of a sudden you don't factor it into your break evens, and then you've got to go pay a massive lump sum at the end of the year of all this massive tax amount, especially if you've gone and made money. And I've fallen personally as a business owner, I've fallen into that trap as well, where I'm going, right, business is going great, I'm going to upgrade my car, I'm going to do this, I'm going to do that, I'm going to invest some capital in the business, blah, 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 blah. And next thing you know, you get a 15 grand tax bill, and it's like, okay, I didn't actually budget that in. So are you factoring in the tax? Are you factoring in, is tax a good thing? And if you can change that mindset, because most you hear about most business owners talking about, I hate paying tax. If you're paying tax and your accountant is a good accountant, is helping you minimize tax as best as possible, but you're still paying it, it's a really good mindset to have. And it's very important to look at, why is it important? Well, there's a couple of things, guys, and there's, look, I'm all for minimizing tax. I'm sort of is, am not. This is where your accountant kicks in. I can't help you with that type of stuff, but minimizing tax is not always the best option. And I will, this story that I actually sent out on the email is a true story, about a accountant that had for years upon years upon years talked about minimizing tax, minimizing tax, minimizing tax. What had happened though, because their business had grown, grown, and grown, they've all of a sudden gone, wow, I've got all this tax minimization, I've got all these benefits, and I'm sitting pretty. But when they've gone to actually go, right, I need to get some loans to invest into the business because of profit and losses, and there was a lot of hiding of figures and whatever else, and creative accounting, whatever it was, what happened is no banks would absolutely touch them to go and get a loan, because they've hidden all of this tax and they've tried to minimize it, and it didn't look good at the end of the day. And what effectively happened is that stopped their business. Now, luckily enough, we did get the finance through personal finance, to do what they needed to, and they're going great guns at the moment. But reality is, minimizing tax is not always the best option. So if you are talking to your accountant about minimizing tax, ask them, what is the best option for me, not now, but in 2 years' time or 1 year time at least? I know that's hard to look at, but what is the best option to be looking at that? So, when you're minimizing tax, the questions you need to probably be asking your accountant, is this going to be the best benefit for one, now, but two, also the future? And Bill might talk about that a bit more. I know he is going to talk about that a bit more on what you need to look at to help with that. All right. Now, the problem with tax and why we don't like paying tax is because we don't plan for the tax payments. Let's put it this way: 30% of your profits that go to the that you give to the tax department goes to tax. Plan for that. If you know you're making a profit throughout the year, go and put a little tax account away and start saving for it. You won't. You'd be happy to pay tax at the end of the year, because you've got the money there. Put your accounts away for your BAS and your PAYG and all of that type of stuff. Reality is, we can't get out of taxes. We all know that. So it's all about putting the money away to maximize that. And Bill will talk about that shortly, about tax planning and the best way to look at tax planning and all of that. So very important to start factoring in and putting money away. And then always have a fair idea where your business is at least 1 year ahead, to say, right, in 1 year time, I'm going to have 2 employees, I'm going to have this new future capital equipment, and this is where I want to be. Share that information with your accountant and make sure that you go, right, am what I'm doing now the best tax setup for me? Very, very important. And of course, discuss with your accountant, discuss the options. What is it, and how do we go forward from there? And what do we need to do to either minimize tax, or should we be paying a lot of tax now, and all of that? At the end of the day, it will catch up with you guys. I'm going to raise my hand up to say I did get caught with that about tax minimization quite a few years ago, that it did catch up on me. Yeah, it was hidden, but sooner or later it will come back and bite you, and sometimes it's going to bite hard, guys. So make sure you are getting the right advice in terms of what you want to do with tax minimization and how you want to run your tax. So Let's look at point 3, guys. KPIs in business, right? This is one of the key areas to help improve your business. And once, actually, the next slide here, let me just ask a poll. Do you have any KPIs in your business at the moment? So let me just launch this poll, and you should be able to see that there, guys. Do you have any KPIs in your business? Excellent. Guys, if you don't know what KPIs are, they're key performance indicators. Yeah. Well, no one's putting 0.5 down there. That's funny. I'll be honest, 0.5, waste of time and energy. Most of the KPIs we get to look at in businesses are a waste of time and energy. They're spending hours and hours writing up all these reports, and my goodness, you only really need 2 or 3 major KPIs that you're looking at. Great, guys. All right, let me just close that. Most of you guys have voted. Thank you very much. Let's go and have a look, and let me share the results with you. Guys, 48% of you are looking at your KPIs, and that's brilliant. A quarter of you guys know but would like to, and that's very important to understand. I'm hoping to give you a few KPIs that you should be looking at your business now. People, KPIs are really drivers of your profit, drivers of your marketing, drivers of your sales. All they are is they're just a KPI is the ability to have a look at something in your business and measure it. That's effectively what a KPI is. It's something that you can go and measure. And I don't KPI. I never working with business owners give them too many KPIs to look at, because reality is we're in business for cash and maybe a lifestyle, i.e., save time and all of that. So let's build our KPIs around that at the beginning. Very important to do that. So let me just hide these results and I'll continue on. The 14% who haven't but aren't reviewing them, if you want to hold your hand out now and give it a nice little hard slap, guys, very important. I'll speak to you about that. One of the KPIs I've put in an organization very recently, October last year, was just a sales graph up on the whiteboard that all the sales team could see it. And there they are going, right, here are your targets. And that was based on the break-even exercise we talked about in point 1. And we worked out what the sales targets needed to be to go and make a really good profit, to make sure you pay all your expenses, any loans, any new capital, all of that. We built this sales graph, and every month, every week on the whiteboard, the sales targets were hit. What had happened, what that entailed was immediately the sales reps could see the sales targets right there every single week and how they were tracking. And because these guys were fairly competitive, within the first month, they'd never hit their sales targets before, but they were never ever documented really. And what had happened the first month, they've hit the sales targets. Up until a quiet period, January and February, they were having meetings about how they're going to do it, what they need to do. Unbeknownst to the team, or the business owners, they were doing meetings all because they were now started tracking their KPIs. And at the end of the March quarter, they just missed it. But that was over a very, very quiet period over January and February. So just by tracking that one little thing, their sales targets as their KPIs, had made a massive difference in their business. So, guys, what do you need to have a tracking at? And one of accountant many years ago for me brought out is what my hourly rate is in my business. This is one of the first calculations that I always like to work out because it's a fairly big slap in the face. And I was running a business. This is well before I knew what I knew now. This is my business running, installing accounting software and all of that. Out there running around, I was working 7 days a week, 12 hours a day on average. The money was okay. It was coming in. No complaints there, but I can tell you now I had no life whatsoever. And what had happened, I sat down with the accountant. He sat there and went, um, sorry guys, someone's just pointed up. Okay, he sat there and gone, he sat there and gone, right, let me work out something. Right, this is how much you paid yourself. This is how many hours a week you work. This is how much profit you made. Let's just add those up. And guess what? I was working roughly about 85 hours a week for $1.85 an hour. And for me, that was just like, you've got to be kidding me. And I just went, wow. Now there is a flip side to that. Was I building a business and growing a business, and was all my hard effort and hard work going to be worth it in the future? Well, it was, but at the time there was a lot of things also affecting it. So that was a really, really rude awakening for me to actually help bring my numbers down and get the strategies in place to change my business around. I'd love you to sit there and work out where you would love your business. Um, and how much at an hourly rate that you are looking at yourself at the moment. I think that's one of the first KPIs that you can work out for yourself, so you know exactly where you're at. Sometimes working at McDonald's is way more time and way more money for some business owners that I do get to meet. The other thing is maximum earning capacity. I don't know if you've ever heard this phrase, guys, but one of the KPIs I love doing with business owners is working out their maximum earning capacity. What does that mean? Well, how much money can you really earn in a week, in a day, in a month, whatever you need to do? Now, if you're swapping time for money, there are only so many hours in the day, and there's only so many people that you can actually see. So work that out. Right, I can see six clients a day. I can charge them roughly $100 an hour. That's $600 a day. Times that by 5, there's $3,000 a week. Times that by your monthly figure, there's whatever it is, and off you go from there. And you can work out exactly what your maximum earning capacity is. For instance, if you're a plumber, for instance, as an example, you might have a team of 3 people. Right, each one of those people can charge out an average, we're talking averages here, an average of $70 an hour. They can only work 5 hours a week because they got travel time in between. There's 3 of them, times that out, great. And then how much money can they actually bring in a week? And there's so many times that I've looked at those figures and compared them to their break evens and gone, you're not going to get anywhere. We need to change stuff. We need to move stuff around. So, what is your maximum earning capacity in your business is one of the great KPIs you can look at. If you do want a spreadsheet for that, happy to give you a spreadsheet. If you're a service industry, if you're selling retail goods, let's put it this way: there is only so much floor space. There is only so many customers that come into your shop at once. There is only so many, etc., etc., etc. How do we actually increase your maximum earning capacity? Well, of course, online sales. If you're a retail shop, you can sell as much as you want. I guess you supply to your demand. If you're a service company, how do you leverage some of the stuff that you do day in, day out? Videos, education tools, whatever. So work out your maximum earning capacity in your business. How much money can you officially make? Then how much are you making now, and look at the percentage. And it'll be very, very rare that I would find someone over 65% sales to their maximum earning capacity. If I'm thinking back now, the last ones I've done in the last few weeks, I would say the average would be around 48 to 52% would be their maximum. That's how much they can pretend. That's how much they're missing out on. 50% of what they really should be getting. So, guys, there's a lot into that. I think team productivity is another KPI we need to look at. One of my clients, we did a quick analysis to go very similar to maximum earning capacity, but how many hours can the team work during the day? How much are they productive during the day? And if anyone believes they can get 100% out of a team member, they're probably, they're living in fairyland, might be a good way to put it. That it's almost impossible because you're going to get interrupted by emails, by Facebook, by meetings, by whatever else. So no team can be productive. You want to aim between 80 and 85%. But monitoring your team productivity is very, very important. So you can work it out. And this client, we worked out that the team productivity was 40%. And we were discussing about putting 2 new team members on. I went, hang on a second, before we go and do that, let's work out your team productivity. Are they running at the most productive? So we worked it out at 40% about 2 months ago. We've now got them up to 65%, and we haven't had to put on new team members. Win-win. Immediately, we've saved a lot of money in the business because we've actually got these guys to be a lot more productive in what they're doing and how they're doing it. So a very important KPI if you do have team. And then, of course, let's look at your project job GP percentages. If you run with cost of goods and all of that in your business, are you actually tracking that GP on your sales? If you're running a retail shop, if you're running a manufacturing company, if you're running a plumbing or a decking company or anything like that, work out exactly how much you're making on jobs. What are your GP percentages? And I know that sounds extremely funny, but so many people just don't do that. Report on it. Know what it is weekly. If you're doing big jobs, 2-week jobs, track it on a daily basis. And ever since that we've implemented this into my tradies and actually gone, hey guys, we need to have a look at every day what your GP is, they've been able to monitor it and change their GPs completely around. So if someone's not being productive, or a team member's not being productive when they're out there doing their work, we're able to identify it straight away and go, right, let's change that. What do we need to do to make sure this job hits their GP percentages that they've put in place? And Bill will talk about benchmarking and all of that later on. And that's important to understand what your benchmarks in your business and what GPs you should be making. And then, of course, the last one is sales and marketing. Are you tracking the leads? Where are they coming from? Is my marketing making dollars, etc., etc.? So, guys, these are the things you need to be looking at KPIs and what you need to be doing. And if you get stuck with that, there's a very, very great website out there. Please write it down, kpilibrary.com. It's free. There's over 3,000 KPIs for your industry in there. kpilibrary.com. Absolutely brilliant websites to get your KPIs. So, guys, the next 2 points I'm going to go through are fairly straightforward. Budgets. Now, big departments, big governments have budgets. They're all there. They're all in place. Do you have a budget? Well, if you do, you may have, but what I see happen is the accountant says, right, here's your budget for the year, go whack it in there, and then leave it at that. You don't know what to do with it. And so many times I walk into business owners where they go, yeah, I've got a budget. I said, great, how'd you hit it last month? Oh, I haven't looked at it. Or they'd go, yeah, I've got a budget, but I really don't know what to do with it. Well, I'm going to make budgeting quick and simple. You've got your break evens. Go and key them into your accounting system as budgets. The next point is, base it off your break evens, as I mentioned, review it weekly or fortnightly. Have a thing where you go, right, if I've got to pay something more than $500 in my business, go back to your budgets and go, hang on a second, I haven't budgeted that for this month. So what do I need to do to make sure I can buy that equipment and move it from somewhere else? So if you've got motor vehicles, let's say budgeted at $1,000 a month, you've got travel budget at $500 a month, and motor vehicles all of a sudden cost you $1,500, and you know you're not traveling anywhere, go and move that. Go and make your budgets live. Go and move $500 for that month out of travel, and go whack it into motor vehicles. And is that a lot of hard work? Maybe, but business is all about money, and reality is doing that in your business will actually make sure you hit your budgets every single time. Plus, you're aware of what you're spending. Think about this: most business owners going, "Shit, I need that. I better go and get it," and not worry about the consequences of what's going to happen in the future or for your cash flow. Imagine you go, "I need that, but hang on, I need to go check if I need that, and if I am going to need that, what am I going to do, or what am I going to reduce to make sure I can afford that?" Because if you've got your budgeted expenses at 10 grand a month, then you got to keep those expenses at 10 grand a month, and off you go from there. And you shouldn't have to have it to make it too hard for yourself. But when I've put this in at clients, all of a sudden their expenses have actually reduced automatically because they're questioning on what's happening with their expenses. So, guys, manage your budgets. Really manage them. When I talk about managing, I'm talking about moving that. And of course, guess what we're doing? Quarterly reviews. Very important to do that. So, guys, last point, and this is the last point I want to talk to you about, is the cloud solutions. Have you got the right software for your business to do what you need to do? And it's funny, most people use MyOb here, and that's okay. MyOb's a great little product. It's fairly good value, but the problem with MyOb, it is getting old. And I'm not saying it's not a good product. I'm not saying you have to change, but what I'm saying is you need to review it, because there are so many other little tools on the market that are cost effective that actually do the job. And I walked into one client and I turned around to him and says, look, MyOb is not going to be the tool for you moving to the future, because you've got 2 offices, you need to be flexible, you do a lot of work from home, and MyOb's not that flexible when doing that type of stuff. Copy it to the USB stick or go whack it somewhere and put it on the server and then dial into the server and you do all of that. and it hasn't been that flexible for them. And then they've rang their accountant, and their accountant turned around and says, no, 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 we only deal with MYOB. We don't want to deal with anything else. We know MYOB. That's what you've got to use. It's the best product. Off you go from there. Well, I've turned around and says, look, let's try it for 3 months with these new software systems out there and see what happens. Well, one of the best things that we've done is put this software in place, because when people are out on site, they can do the invoices straight there, straight then, right on their smartphone, and they're able to bill way quicker for what they actually do. So putting stuff like programs like Xero and Dropbox into their business, and Dropbox is not an accounting system. I just wanted to talk to you about that from a Maya perspective. But putting Xero in place was absolutely amazing for their business. It was cheap, it was effective, and it's just made a difference, because they can be online anywhere and get to all their accounting data. They can do invoicing on the fly. They can actually make it happen. But and I said I won't bag accountants, and I still won't. But there's still maybe this is bagging it, but there are still accountants out there that says, no, MYOB is the bee's knees. We need to go from, we've got to keep using it because it makes your life easier. Well, let's have a look at what's going to make the business owner's life easier in the business. There are systems out there. Xero's not the only one. There's Zeus, there's Brightpearl, there's all these different cloud-based systems that are absolutely brilliant. And if you are interested in looking at these, now is the time. We've got the new financial year coming up. Damn, how quickly has that gone? New financial year coming up in June. So now is the time to start reviewing that. And if you do want, one of my clients actually sells Xero, and I was talking to him about the webinar that I'm doing. They're going, oh, you're going to offend all of us. I'm like, no, relax. I'm not going to offend all of you. But what they're offering is 5% off Xero. So if you do want to go ahead with Xero, they're offering it at 5% off. It is a very, very cost-effective tool. So if you are interested in that deal, or interested looking at Xero, I think it's worthwhile investigating your software system now. Xero does amazing things, and I love Xero. I use it personally, so I can talk about what it does. I have put it in quite a few of my one-to-one clients, and they absolutely love it. It's been amazing in their business. It has made their business different. And the add-ons that you can get with Xero, like Receipt Bank and all of that, if you're out and about, you take a picture of your receipt on your iPhone, submit it, and all of a sudden it just uploads into Xero straight away. So there's no data entering. It automatically goes on there. If it's got automatic bank feeds. Here's a screen of it now. Automatic bank feeds in, so you don't have to worry about bank recs. I personally can run my accounts in about 7 minutes a week using Xero and doing all my bank recs, getting them up to date, and it's done every week, about 7 minutes, and that's it. So guys, there are other tools out there. Your accountant might not be talking to you about them, but there are other tools out there that you should maybe be looking at, and what is more cost effective. So, guys, there's the 5 points I wanted to talk to you about. These are the ones I'm really working with business owners at the moment. And I'd love to hand over now to Bill, and he's going to talk about what makes a good accountant. So let me unmute Bill here and make sure I can hear him okay. Bill, can you hear me okay, sir?
Yeah, it's all happening.
All right, guys, can I have a hands up if we can hear Bill, please, if you don't mind? And Bill, start talking for us.
Oh, look, yeah, thanks for the opportunity to outline what I think is a good accountant.
All right, Bill.
Sorry,
Bill, I'm going to let you know you do have control of my computer now, so please don't run havoc, but all yours, sir. Over to you.
Okay. Yeah, and thanks for not bagging out accountants, because given you got a black belt in martial arts, I don't think I've got many rights of retribution. But look, I've sort of framed it as in 5 points that you could look at to sort of assess if you've got a good accountant or not. So that's sort of the framework of where we're heading today. Now, my first point is, I'll just click to the next screen. Okay, many people probably aren't aware of this, but you actually, anyone can call themselves an accountant. So you don't actually, there's no legislation that says, hey, Joe Bloggs off the street says, I'm an accountant. There's actually nothing against the law to prevent him from doing that. So what the industry has done is we self-regulate. The major bodies, the major professional bodies are the Chartered Accounting Association and CPA Australia. There's other associations. One of them is the IPA. So when we offer our services to the public, we've basically at that point, then we do have to deal with some sort of legislative issues. So if, for example, you need your self-managed super fund audited, then under the SIS Act, they would define what an accountant is. And then that accountant is actually then referred back to these professional bodies. So it's a little bit boring. The reason I just simply mention it is just so, look, if you want to, if you're looking for a good accountant, well, one, you need to make sure they are an accountant. Another issue to come up is the only people who can give tax advice is actually a solicitor or someone who is a registered tax agent. So most people who are in business are dealing with an accountant who's offering their services as a public practice accountant, and now they also are probably doing their tax return. So you really want to make sure that your accountant does actually have a tax agent certificate. I get a weekly magazine, and you'd be, well, it's a monthly magazine issued by the accounting bodies, and you'd be amazed the amount of actual tax agents out there that actually do something that's fraudulent. So just be aware of that. The other thing is in every state there's a Professional Services Act, and again it is a requirement that if you provide professional services that you must meet in certain criteria. It more evolved out of the goal of setting sort of limited liability on how much you could sue your accountant, but the main benefit to the end user is that basically you're required to receive an engagement agreement. So an engagement agreement should set out the terms of what they're providing to you. Refer to that engagement agreement. A good accountant should be giving you one because it's required under law anyway, and then you'll know exactly what you're getting. Often it might address issues regarding price. So some of these things pop up as things that people end up having arguments about. So the engagement agreement is one way, is a good way to address it. Okay, so what would a good accountant be providing? I would have thought, well, firstly, I'll just define what I think the next step is. You've actually got an accountant. A good accountant would be a proactive one, and by proactive, I mean they're contacting you before you're contacting them. And then it would be, well, look, what are they contacting you about? My point here is that they should be contacting you about tax minimization. Now, firstly, it would be about basically the way you're structured. So whenever someone comes in or they're starting a business for the first time, you should be reviewing your structures, and the structures are the use of companies, trusts, and self-managed super funds to legitimately minimize your tax. So I think what Nathan might have been referring to before was accounting entries that help you minimize your tax. And yeah, look, again, I agree with his sentiments. They can just, they can actually bring you undone, especially when you're going for finance. So not only should they have set you up properly, or if you've come into them and they've looked at your structure and said, hey, look, we should be doing this, we should be doing that, things change all the time. So the ATO don't write the law, they administer it, and they have interpretations of the law, and those interpretations can change. And one of the huge ones that came out about 2 years ago was a tax ruling that changed the treatment of anyone who was operating a business that was earning or was generating considerable profits, and they were distributing some of that income to a company. Now, what that had traditionally achieved was it meant that you pretty much paid tax at no more than 30%. This ruling changed that that interpretation that, okay, look, you can still do that, but you're going to need to hand the money over to that company. Now, like Nathan said before, you might make $200,000 as a net profit, and there might be taxable income, but more often than not, you won't have $200,000 in your bank account. Very likely you'll have $50,000. So the rest of it's tied up in plant and equipment or debtors or WIP. Sometimes it's gone to paying off debt. So simply that ruling was very restrictive because you just won't have the money there to actually pay it into that company bank account. And then you don't want it sitting in this company bank account sitting over there doing nothing, even if you had it. You had the funds there in the first place. So if you are operating in a business and you are in a trading trust, then that's something that you really should have been either have spoken to your accountant about, or he should have contacted you about. Look, in addition to administrative changes that the ATO make in terms of the interpretations, there's legislative changes as well. So new legislation is being written all the time. Sometimes it gets passed, sometimes it doesn't. But an example would be if you're a small business where your turnover is less than $2 million, not all that long ago, the pooling arrangements were changed for assets. So if you had an asset that was cost less than $6,500, you'll get an immediate tax deduction for it, which is an increase from $1,000. So that's pretty significant, but really, if you don't know about it, you can't take advantage of it. So ideally, your accountant would have either sent a newsletter or an email specifically to you as a small business entity to let you know about those sort of changes. Look, Another thing, another area of tax minimization is look using superannuation. I mean, there's some recent movement in that area, but generally, as a general rule, look, if you're under 50 in the past, you could contribute $25,000 in there. If you had the funds available, that's great. Throw it in there. Yep. Tax in superannuation is 15%. So we're using companies to try and keep the tax at 30%, but we can use superannuations to try and get the benefit of having income taxed at 15%. So again, if sometime you're talking to your accountant and nothing has ever been mentioned about the use of super contributions, or it's all too late, you need to know this stuff before the 30th of June. That contribution has to be made before that date to get the tax deduction. That they really should be addressing that issue. Now you might be going quite well, you might be generating a lot of money. So another issue that can help minimise your tax is negative gearing. Your accountant, if you're making a lot of money, your accountant should be talking to you about negative gearing. It's a valid investment option. It's something that it should be addressed. Probably finally, look, I'm talking here about tax minimization, but the scope of it extends way beyond income tax. I mean, I'm fairly ambivalent. I'm happy enough to minimize any tax. So, with clever decision making and planning, you can reduce GST, you can reduce CGT, you can reduce land tax. You can reduce stamp duty, you can reduce payroll tax. So these are lots of issues where you would just legitimately say to your accountant, hey, are you minimizing my tax? And then you might add to that, like what can we do about land tax? What can we do about payroll tax? What can we do about stamp duty? These are all areas where something can be achieved. Now, a proactive accountant would also have your assets or your interests at heart and seeking to protect your assets. So again, they should be using structures such as companies and trusts and also self-managed super funds. If you're an association, you should be incorporating. All of these go about sort of protecting your assets. So a question you would ask is, hey, so are my assets quite well protected here? So I've just this one's sort of like asset protection machine gun style. So here's a quick summary. So if you're in a trading trust, which I've said, look, may not be the most tax effective structure going forward, do I have a corporate trustee? If you have an individual as trustee, that's just insane. Probably in addition to that, if you're a company or you are still trading in a trust and you've got a company as your trustee, how many directors are there? You only need the one director. So if there's more than one director, you need to change it. If that company's formed before 2000, it's easy enough to have the constitution updated and reduce the number of directors that's required down to one. Now look at all your other myriad of structures that aren't really subject to risk. That's where you'd probably have the other partner. So if there's a husband and wife and the husband's the director, then in many of the other investment structures, you would typically have perhaps the wife as the trustee or the director of a trustee company. Another important one is you might be in a really litigious industry. So you might be in the building industry. Very, very often people will set up more than one entity. So you'll have an entity that you trade in. You'll have an entity that maybe holds the employees. You might have another entity that holds all the plant and equipment that you use, and then you might have another entity that you use to invest with, and then even more elaborately, you might have an entity that actually just licenses the use of the business. So all those structures are put in place that if there is an issue with trading and there is an insolvency matter, then you're pretty well protected going forward. Look, sometimes people have contributed a lot of money to their businesses, and so effectively the business owes them a lot of money. Well, look, you can secure that debt just like a bank can secure a loan. So again, if there was a problem, if you haven't secured that debt, then you're just going to rank like every other unsecured creditor. So you should be talking to your accountant about, hey, look, what can we do even to protect my investment in the business? Okay, there's another thing. If you have multiple entities involved, you should be offsetting the balances between those entities such that you can say, okay, well, we've got all these structures in place, but if there's all these loans sitting around between them, it can undermine some of the goals of that asset protection and setting up those entities. Another one is, look, if you've got your entities all set up, but the house is in joint names and one of those parties is a director, look, you've exposed half your house. So you might very well consider paying a bit of stamp duty and incurring that to then transfer half the interest in your house to the say in this case the wife, the non-risk spouse. If sometimes your house can be quite valuable, so the stamp duty can be pretty cost prohibitive. There are actually trust arrangements where you can achieve a similar outcome, normally involving the use of a solicitor. Again, it's just that's where you'd be asking your accountant, saying, "Hey, is my house protected? You know, have we protected the business? Have we protected my stuff outside of it?" Another one is you might find that you've got all your finance through one entity. Well, if that is the case, there's this thing known as an all monies clause, and it's a bit of a sleeper, but what can happen is you might have not made a chattel mortgage repayment on a trading entity that's in trouble, and you've got your home loan with the same lender. Well, under that clause in that loan agreement, they can actually sell your house. So by using multiple lenders, you'd unlink what's known as this all monies clause, because you've only linking them to probably your house to someone who you will never not pay, and then in that scenario you'll achieve protecting your house once again. Look, there are certain industries that are regulated by the government. Here in Queensland we have the Queensland BSA, which is a body to protect home builders. So in that scenario, if you use a trust, you won't achieve asset protection. So again, you'd be using a company. So there's some that's a pretty quick summary of sort of asset protection. And really the question is, look, are my assets protected? Look, there's heaps of other areas an accountant really should be giving advice on. They should have a look at your figures and give you some advice on, hey, look, your financial performance is pretty good, or it's not so great. They should be looking at benchmarks. The ATO have benchmarks. If you're outside of those benchmarks, you might get audited. They should be looking at, if you are doing really well, hey, great, we've protected your assets, that's fantastic. 2, we've kept you taxed on minimum, but what are we doing now with all these funds that are being created? And that might lead to certain investments, certain structures, and then also the involvement of a financial planner. Look, the business might be going okay, or it might have potential to do a lot better, or it might be doing poorly. And that's again where the use of benchmarks or historical trading would reveal that, hey, look, you guys look like you need some help there, and that might involve the assistance of a business advisor or business strategist to try and help you improve your performance. Look, sometimes just straight out, the financing's just all over the place, and so you get to see it as the accountant. So you should call them up and say, hey, you know what, you need to go and see a finance broker, because you got 15 credit cards and you got 4 loans and 1 overdraft that you don't need, and it's not hard. You can see it there. It's right in front of your face. Your accountant should be telling you that stuff. Okay, some other areas. Just waiting for the slide to come up. Look, and this is the negative side of things. Look, sometimes you're not going that great, and look, sometimes it's foreseeable that you probably might find that you'll go under. Well, the accountant's the first guy that should be telling you, hey, look, we've got a problem here. And the thing is, you can put in place strategies to ensure that, hey, look, maybe your business does go insolvent, but you don't necessarily need to lose a house. And look, other little things, there's lots of government support out there. If you're doing export, there's grants available. If you're doing R&D, there's massive tax concessions available. Look, you might have not earned very much money that year, and you might be entitled to Centrelink benefits. So these are all things that I think a proactive accountant would be telling you about, and it's a pretty easy stuff to note when you're completing the accounts as a part of the year-end review. All right, so this is the big reveal, I suppose, that I put as my 5th point. And you want an accountant that's proactive. Now, I've wanted to, and some people will refer to them as a proactive accountant. I've made the comment that you can actually have a 2 active accountant. So that would be someone who is going far beyond the scope of probably what you really need to do. So. Well,
sorry, Bill. That's me accidentally touching the mouse. And
okay.
Sorry, Stacey's had a very important question to ask. But if it's okay, Stacey, we'll get to those questions shortly. So, Bill, I'll leave it to you. We've got about 1 minute left, and we'll go from there.
Yep. Okay, if you looked at every business from a corporate view, everyone has their role: management, accounting, legal, IT, finance, marketing, sales. Now, you're the CEO. The business owner is the CFO. If you're not big enough to have a full-time accountant, the accountant is effectively, your public practice accountant is your CFO. So you want your accountant to help you in those areas, but not go into other areas which he doesn't belong, such as sales, marketing, HR, and administration. Now, you can go out and look at every accountant sign on a board and it says they're accountant and they're a business advisor and they say they do business development work. But business development work is probably incorrectly named and it's really financial analysis. So financial analysis involves, monthly accounting, budgeted profit and loss statements, balance sheets, cash flows like we talked about before, prior year historical analysis, vertical analysis of cost of sale margins, wage percentages. You can do, like we had discussed before, KPIs, job analysis, hourly rate reviews, productivity reviews. That's where the accountant gets involved. The next step above and beyond that is, okay, you know what the conclusion of most financial analysis is you need to increase your revenue, increase your efficiency, or increase utilization rates, while at the same time monitoring liquidity. So you can spend all this time getting all this financial analysis done, but really the end result isn't that obvious. And it is quite obvious, is look, you know what you need to do. We can put all these numbers around the framework of it and what we can try and target, but in the end, you need to know that the accountant's role stops there. That's where the CFO then says, the CEO goes back to the marketing people and says, we need to increase sales. How do we get those sales? So that's where I say, I know where my role as an accountant ends and where the role of, say, a business strategist would come in. So someone like Nathan, for example. Now, there's something that's happening out in the industry. There, just as there's business advisors to every industry, there's business advisors to accountants, and more so, there's a real pitch to try and provide what's known as value-added services and value-based pricing. So that is very much a marketing area, and it's really being introduced to accountants. So what you'll find is more and more you've got accountants out there selling services and marketing services that maybe you do need, maybe you don't need. And the typical pitch would go something along the lines of, look, we've analysed your business. We believe if we made a few changes here and a few made changes there, we increase productivity, we increase average hourly rate, or we lift our profit margin, our gross profit margin, that we can get your profit up by $50,000. But what you need to do is you need to work with us for 12 months. Look, it's an upfront fee of $12,000, but look, we're going to do cash flows, we're going to do budgets, we're going to do monthly financials, we're going to do KPI analysis, we're going to have a quarterly meeting, we're going to do tax plan, we're going to do all this stuff. And you're sitting there and you're overwhelmed and you're trusting this person and you're thinking, wow. But what you're probably missing is that, look, one, you don't realize you've never dealt with an accountant basically selling or marketing their services to you before. That's not the traditional sort of trusted advisor role. You don't expect that. You expect a car salesperson to do it. You might expect a marketing person to do it. You know what you're getting. But with accounting, it's something new for the end consumer. So that's the caveat. Be warned. It's an increasing sort of tool that's being used in the industry. Now the thing is, with all that analysis and all those goals and all those plans and all those meetings and all those KPIs, the thing that's missing is they're not going to tell you how to do it. You're the one that has to go back and you have to work out how to increase sales. The accountant does not know how to do that. So in the end, it falls back to the business owner, and if that's a skill set that he's lacking, he needs to then address, look, who am I going to get to help me to do that? And that's where the role of, say, someone like Black Belt Business comes in and says, hey, we know what we've got to do, but I need some help on how to do it.
Woohoo! He gave me a plug.
All right.
Awesome, Bill. Excellent. Hey, Bill, I'll say thank you, Bill, for that. And, as I said, his peers might lynch him, so his name's really not Bill Parks, it's John Smith. No, I'm only joking there. Absolutely fantastic. I hope you got some out of that. Now, what I got out of that, and I'll share what I got out of that, was communication. I think you really need to ask questions with your accountant, but why? And I think that's important. You want to minimize my tax, but why? What is it going to do for me? And then be able to actually understand that. And I don't know if that's what you guys got out of what Bill mentioned then, but that's what I hear definitely out of that. Would that be a fair call, Bill?
Yeah, definitely.
Cool.
You want to be able to say, are you minimizing my tax? Are my assets protected? Are you saving? Are you helping me with have you reviewed my financial position? How am I going as a business? Am I going good? Am I going bad? I don't know. I'm thinking I am, but I don't know. You need someone to bounce that off.
So, guys, I'm going to provide a whole heap of list of questions that you should be asking your accountant. Put your hand up if you'd love that. Who would love that? Because a lot of people aren't sure. 44% of you guys aren't sure. Whack your hands up on the screen. Excellent. Yeah, look, guys, that's most of you. I'll organise that list of questions for you, and then we'll go from there. So, guys, thank you very much, Bill. I'll just mute you now and we'll come back to Bill in a second. I know we're 3 minutes over, so I won't talk too long. Guys, we're pretty much finishing now. I just want to quickly share with you, and you've got time for question and answers, so if you do have time, happy. I know there's a really good question here at the moment for Bill to answer, but have you built a vertical business? And this is important where your accountant really needs to come in, and I don't know if anyone of you ever heard that terminology, vertical business. Let me share that with you on what I'm talking about when we talk about a vertical business. And I just need to quickly do this. Quite simply, guys, as business owners, what actually happens is reality is we're good at what we do. All of a sudden we go, I'm a great electrician, so I'm going to go out and build my own electrician business. And what you're good at is you're extremely good at being an electrician. So you build that vertically. You're extremely good. So here you are as a business owner sitting on top of your vertical business because you're really good at what you do. But what happens is a tiny bit of wind comes over, and guess what? You get blown over. And effectively the GFC hits as we've been, going through and whatever else. That wind takes all of that out. You get sick. Well, because the business is built on you, the business doesn't continue. So a vertical business is really what happens when, you've just built it on you and your skills and what you're good at. And reality is good businesses that grow and move forward, what they do is they build a solid foundation around that vertical business. So, you're great at what you do, stick at what you're good to do, but get your accountant to work on what they're good at, which is their accounts. So you build the accountant should be actually building you some solid foundations. Get your sales in line, get your marketing in line, get all of those areas in your business. Excuse my scribble writing, guys. But get all of them in place in your business. That is very, very important to build those solid foundations up front. I've watched businesses being around for 20 years, still built on the business owner. So reality is try and get out of the vertical business type of areas, and that's very, very important. And your accountant should be able to help you do the finance side and be able to put all of these things that we discussed in place. So, guys, I'm not going to talk about this now. I don't need to talk about this now. I've got a great program to build those foundations, which is for small business owners who don't have the money to go and spend $12,000, as Bill talked about, on knowing what needs to be done. The program starts from $297, and you get all the questions answered that you ever need in your business. But again, what I'd like to do, if you are interested on building your foundations, growing your business, having the support that's not going to cost you the earth, I'll send out in the email that I'm going to send out. There's quite a lot of information I'm going to send you. You can book in a 15-minute phone call, and I can find out where you're at in business, what you need, give you the ideas, and then and talk to you about how we can build those solid foundations for you. So, guys, I'm going to leave it at that. I just want to hear from you guys. Please whack in the comments or the questions. What was the number one thing you got from today? I'd love to hear from you guys. Number one thing you got out of today, please. What are you going to implement in your business? So, oh, by the way, Sandra did mention before, MyOb has a live account, so you do have MyOb has an online cloud system as well. Not too sure what that was like or is like, but I haven't really reviewed it, but they are there. Budget, excellent. Definitely put budgets in place, guys. All right, number one thing in the comment sections, everybody. Let's share the love. Okay, more comments coming. Oh, there we go. Need set sales targets. Absolutely. KPIs are important. Zero is fantastic. More KPIs. Thanks, Scott. That's not all accountants are actually accountants, and budgets. Great. And some great tips to ask your accountants. Thanks, Leanne. Make an appointment to see your accountant. I think that's important, guys. And as I said, I wasn't bagging accountants at the beginning of this. I want you guys to work better with them. I work very, very closely, and I know my accountant's on the line at the moment. I work very, very closely with my accountant and all the clients around him, and we strategize together on what we need to do. He looks at it from a financial point of view. I look at it to make sure it gets implemented. Protection of assets, planning. Definitely your financial. Look, guys, there's heaps coming through. Get your accountant to be more proactive. KPIs are very, very important. Yep, and Jan, Maya has only just gone to the cloud. It is brand new, so there you go. Yeah, Zero's been out for a very long time. So, and it probably sounds like a sales push to Zero, but I just look at the tools that help business owners and what works, and that's why I push it. So, guys, I want to thank Bill. I'm now going to open up for some questions to Bill or myself if you want anything answered whatsoever. I do have a question already, so I think the best thing I can do at the moment for that is probably just create a new slide. You probably see my screen flipping everywhere, so let me just move that. Let me just come here. So, guys, thanks for that. If you do have any questions, please stay on the line. Happy to answer them. Bill, I'm going to unmute you if I can get my screen working. Damn, I love technology. Bill, are you back? You there,
Yep,
Bill?
I'm back.
All right. So I've got the first
Yep, I'm back.
question coming in. Do you want to have a quick read of that if you can see that?
Recently, I had a customer say that his accountant wanted $5,000 per annum to their super fund so that a $5,000 personal life policy could be paid. Look, yeah, I guess it's quite common in that life insurance is not deductible as an expense to the individual. So but life insurance is deductible inside a superannuation fund. So it's pretty common really for if you're looking over someone's work and you see that they've got a life insurance policy in their own name, that you'll call them up and say, hey, look, you know, if you're dealing with after-tax dollars paying for that life insurance, so why don't we call up your insurance broker and we'll redirect it so that the insurance is now running through the super fund.
Okay, so is that a legitimate expense then, by the way they've set it up there?
Yeah. The way it goes through is effectively it's originally now it's a super contribution. So I suppose the only time the only time it could be a problem is if you'd input so much money into super that you exceeded. Say both couples are under 50 and they'd both put in $25,000 each, then putting in the additional five would be excuse me, would exceed that threshold. But presumably, if your accountant's telling you to do that, he's probably remembered that and said, "Hey, look, when you guys go to put in any additional superannuation contributions at the end of the year, he's borne that in mind and kept it all under the total contribution of 50."
Yep. Okay,
So yeah, it is claimable.
so I've got another question from Paul. Can the life insurance go through a SMSF?
Yeah.
Oh,
Basically, that's what everyone's doing.
okay,
Yeah.
SMSF is a self-managed super fund for those people who don't know. So the answer
Yeah.
to that one is yes.
Yeah, typically what you'll do is any sort of industry fund will have life insurance built into it as a part of their sort of constitution, saying, look, we're helping people. We want to make sure that if they die, that their dependents are going to be fine as well. But if you go and set up a self-managed super fund, which is increasingly more common, you might take all your funds out of that regulated industry fund, plonk it into super, but you've forgotten to organise life insurance. So typically, then you need to go and find an insurance broker or just Google it, and then organise life insurance in your super, and that's typically the way it's done.
All right, so I've got a feedback there. Woohoo! Thanks, Bill. A great strategy for my clients because that's a selling point for life insurance people to actually know that and know ways around to ensure that it does become a taxable expense at the end of the day. And I didn't know that, and I'm paying life insurance out of myself personally. So that's a good way to go about it. So that's awesome. There's a couple other comments here, guys, from people regarding the zero stuff. They're saying zero, I love it. There also is one from a bookkeeper here that says zero does cloud much better than my old cloud. So again, I'm not. Guys, there's so much out there. Someone commented about Seuss. saying Seuss is absolutely brilliant as well. I guess you really need to look at what the best software is for you, and now is the time to look at software in your business, being 1 July coming up. So I know from my background, I can probably advise you on that. I don't put Xero into all of my clients. I've got them into other accounting because that was my background beforehand doing what I'm doing today. So I really looking at that. Doing that. Okay, so we've got a question. The is a KPI spreadsheet easy for the layman like me? I won't mention any names, so absolutely, guys. If you want to have a look, and I'll share with the spreadsheet. Let me go to my wonderful tools that I've got here. Where's my strategies and finance? I've got heaps of tools, guys, for you to use if you need anything. I call it sample budget, but it is my break-even spreadsheets. What actually happens with this spreadsheet if it comes up, so you can see what we're talking about here. I know we've gone well over time, guys, so hopefully you're finding value out of this. The webinar has finished. We got the use of Bill and myself here to answer any questions. This is what I actually provide clients when I first start working with them, and that's the first part of my program is work out your break evens. And I've got a full education on how to do this on videos and how-tos and whatever else. But this is a really easy spreadsheet to work out to go, well, hang on a sec, this year I want to pay $10,000 off my loan. So if I go and key in that amount there, immediately it actually says, right, if I did that, that's changed my sales figures to how much I've got to hit in the year straight away. And I break up marketing because I believe marketing is an asset. So, I keep marketing separate so we can see, right, if we go and do all of this, this is how much we've spent on our marketing. We break it down. We then build a plan around that, and then it will actually show you the impact on the sales that you're actually making. Let's say you don't have, let's say you got a 60% cost of goods. You just type in 60, all of a sudden your sales just completely double. And this is where you look at sales required. So sometimes it's not selling more that's going to give you more of a profit, by the way. Sometimes you need to reduce some of the cost of goods, which will increase your profit more than selling more. And it's just a numbers game. So you outline all your general expenses and all of that, and it will tell you clearly right here how much sales is actually required. So if you want to make 50 grand profit, watch what the difference is. Let's have a look at the daily figure of $2,669. If we want to make $50,000, 20 grand extra profit, it works out to be an extra $280 a day in sales to get that $50,000 worth of profit. So it's a really, really simple tool to use. I hope that answers your question there. Is the KPI spreadsheet easy to use? Absolutely. So that's very, very simple. I'll send you a copy of that, guys. And once you know that, I can then help you break that down and go, right, what are your highest margin selling products? What do we need to focus on? Let's just focus on one marketing campaign that we know that will sell way more of them, and let's go and hit those sales targets. And, I know every client that I work with doing this, just their sales increase fairly quickly because we're now monitoring it. So hopefully that answers your question. In regards to can a layman do that one? Absolutely. I've got other spreadsheets to manage KPIs. As I mentioned before, I won't go into them now because we'll be here forever with all the tools, but I've got videos to show you how to implement all of them as well, and that's part of my Path to Business Mastery course, guys. So, all right, we've got another question. Hopefully I can read this out okay. We used some money from an offset loan to prop up our business when the global financial crisis hit us really badly. So now that we feel the business is healthy, we would like to pay back the money. If this money wasn't income in the first place, will we pay tax on that? Bill, that one's over to you, sir.
Yeah, that one's a great one. Yeah, look, that you've put the money in, so it owes you that money, and then when you take it back out, it's just taking the money back out as money that's owed. So no different to getting a loan from a bank. Just the bank isn't ANZ, it's you, and you repaying that money back. So yeah, it's all tax-free money. So yeah, you won't have any dramas there. In fact, you could have even gone as far as, because when you borrowed the money, you were being charged interest on your overdraft loan. You could have claimed interest in the company for the interest that you were being charged in your overdraft as well.
And that's an interesting point. I know when I set up my company structure, and I'm happy to share this with you guys, how I got, or my accountant suggested I set up my company structure. I've got my mortgage account here, but what I've able to do, I got set up with a mortgage where I'm able to split it into sub loans, here, here, and here, and then effectively over here is my non-tax deductible debt, and that's the one I want to pay off as much as possible. All my money that I make, when I pay off my mortgage, goes to that non-tax deductible debt area. Over here is my business loan. So the money I invested into my business is a loan, and the accountant set up a loan agreement. Bill, you could tell me what it is. I'm not too sure what they're called, form number 474 or whatever it is. Set up a loan agreement between my company and myself personally that now I can actually claim interest on that I'm being charged on my mortgage. I can claim interest back to my company on that. And that was a very, very good way to do it because I've now got the trust here to protect my assets when I'm actually dealing with that as well. So it was a very, very good thing about company structures. I know when I first started in business, I didn't get any of this advice, and all I did was went and created a proprietary limited company. At that stage, it wasn't the best thing that I should have done. So I'd ran that for 4.5 years and lost so many opportunities because I was investing back in my business and it just didn't work. So there's so many things that we've got to look at this way that can be done smarter. And the good news is my business loans are all at 6%. I'm not paying a normal, typical business overdraft loan or anything like that between 9 and 13%. So there's so many cost savings that can be made in your business by just talking to your accountant and getting these type of structures set up. And Bill, please poo-poo that idea of things are changed and all of that. But that works a treat for me, and absolutely love it. I'm reducing my non-tax deductible debt, and the business is paying for the interest on the other side.
Yeah, look, that's there was an endless stream of tax office rulings on what was known as linked or split loans, but yeah, for the most part, you could say at face value that's basically correct.
Yep, and that's again, if it's not correct,
You
then
just want to
please.
be able to clearly show that yeah, you just want to clearly be able to show that those funds that you've drawn down from the mortgage are, clearly going into the business. So it's a fairly simple line. By having the loan split, it makes it a lot easier to see that flow of funds. And then
Yeah,
yeah, whatever the relevant interest is on
yeah,
that business loan component of your mortgage,
yep.
it's tax. It's basically tax deductible to the business. Really, there should be a loan agreement between yourself as the lender and the actual underlying business, but you know,
Oh,
you,
look, I'll
you only have to pull it out if you're asked for it.
and again, I'm pretty sure that's all done because I know my
Yeah.
accountant's definitely proactive, and Bill, I know you're very proactive with all your clients and all of that. So, guys, it's about making sure you ask the right questions. So, guys, I've got no other questions up on so Stacey's mentioned check your mortgage contact as you may be in break if you are using the funds for business purposes. So yeah, there's a whole heap about it. And that's why you've got to talk to your accountant, guys. These are communications. You don't know what you don't know. Your accountant knows a lot. They should be providing that information for you, and all of that. So, guys, if you don't have any more questions, I know there's a couple of breach. Sorry, yep, breach of your breaking. Thank you, Stacey. Guys, I really do appreciate it. I've got no more questions there, so thanks for staying online and going over time. I know most of you have stayed. So, guys, I'm going to have the recording up, so if you want to go listen to it, send it to the ATO. Get me in trouble, let them know, all of that. Go for your life, guys. But at the end of the day, we're here to help you, and that's what these are all about. You'll get an email from me. I'm going to say Monday, people, because I've got to get all the questions and all of that laid out and make sure I give you the right information. So by Monday, you'll get an email from me. Let's book in a call over the next week or so. Let's talk about how we can move your business forward. So guys, have a great Friday. Have an even better weekend. And Bill, I want to thank you very much. I will also send you Bill's contact details if that's okay with Bill. So if you do want to ask him any more questions, I'm sure he's happy to answer. So guys, have a great week, and we will catch up with you shortly. And thanks for the feedback, guys. Um, Jan, awesome presentation. Yep, thanks for that. In depth. We have a vertical business, and and that's okay, Jan. Most people do. Let's actually change that for you. So that's what we're here all about. All right, guys, have a great Friday. Have a great weekend, and I'm looking forward to chatting with you all soon. Wait for the On the Mats next week. It's going to be brilliant, guys. If you don't know what I'm talking about, it's a newsletter. I've got a very, very good topic next week. So looking forward to it. Have a great one, and talk to you later.